Dr. O, every Monday you publish a column in the Center Square. It's the week ahead, Everyday Economics. Look at what's happening on the calendar. There's a bunch of stuff that's coming up this week, but I don't think anybody's going to be talking about anything more so than the Fed decision on rate on Wednesday. So, this has been a recurring, obviously for us, it's a recurring conversation. Last week, 10 days has been pretty rough in the visible markets, and or the markets that I think that most Americans would see. What are your feelings going into this week?
I think nothing's really changed. I think the Fed's staying on the sidelines, partly because the labor market, although the labor market softened a little bit, it's still pretty strong. Partly because inflation had been rising, accelerating up until this latest CPI report that we got just a couple of days ago. The CPI PPI reports showed inflation had eased in the last month, which is good news. So Fed's going to be on pause, and Fed's also going to be on pause because it just doesn't know how things are going to shake due to the policy uncertainty, the constant policy sparring in Washington, D.C. And also, of course, we also have this government funding deadline.
Right. Once again, the government's on a verge of a shutdown, right? Well, let me ask you the question this way. I mean, and shoot it to me straight. I can take it. What is it going to take one way or the other for the Fed to adjust the rate up or down? I mean, what would we have to see? I mean, I alluded to this at the beginning, the visible change in the market. We had technically a correction, in the stock market. I mean, we had, prices down 10%. I mean, that makes people a little bit uneasy. It's been chalked up as, turbulence by the Trump administration, and it absolutely it's turbulent. But what, the Fed in theory, and I guess in practice, to be fair, rises above the blips. And so what would it take for them to move?
Remember the Fed's mandate, right? The Fed is concerned about the real economy. So it's inflation, unemployment, financial conditions. And so everything is still in place. And so as long as everything stays in place, the Fed's not going to do anything. Inflation expectations have actually been fairly stable.
Mm-hmm.
So as long as you don't see an uptick in inflation expectations, or a big decrease in actual inflation, or an uptick in the unemployment rate, the Fed's not going to do anything. Sometimes, I mean, it is good for the Fed to be kind of forward-looking. I mean, they tend to be somewhat, but we know from our time with the Fed Chair Powell, that he's kind of presided a very data-dependent Fed, right? And so they're going to continue to wait and see. And ultimately, it's really, really difficult to try to forecast where things are headed. One morning you have tariffs, the next morning you don't have tariffs. The tariffs could vary in magnitude by so much. The industries affected change all the time. And so it's very difficult to figure out where things are headed. I can tell you right now, though, that the immediate impact of a stock market correction is an immediate drop in consumer spending. Consumers pull back when we call it the wealth effect. Mm-hmm. If you feel richer, you spend more. If you feel poorer, you kind of tighten the belt. And so it's likely that we're going to see kind of consumption growth ease, in the first quarter, ease further. I mean, look, right now, Atlanta GDP now, Federal Reserve of Atlanta GDP now figure that estimates real GDP, is in negative territory.
Right.
So So things are looking like we're slowing down. We may be slowing down faster than we had hoped, or that we had expected at the end of last year.
How about the only other, I think, I mean, of course, there's always things on the calendar, right? I mean, we're going to get U.S. retail sales, and I believe you said that. And then but we have home builder confidence coming up on Monday, on St. Patrick's Day, and you work in that space, you focus on that space, in addition to working in that space.
Consumer sentiment is at a 29-month low. That's the breaking news this morning.
Yeah.
When I just talked about the wealth effect, when consumer spending typically drops by 2 to 5 cents for every dollar of lost stock market value.
Mm-hmm.
It's so, and the sector that is usually most impacted is residential construction.
Okay.
Right. So when consumers spend less, they're less likely to buy cars and houses. First, they trim the big stuff first. And so unfortunately, I don't expect builder confidence to increase all that much. Builder confidence was already in negative territory last month, the past couple of months. Mortgage rates have dropped a little bit, but they haven't dropped a ton. There's a lot of uncertainty around tariffs, and the way they could potentially impact builders. So I don't expect a big, great, very good uptake, positive news there. The other thing I want to say is you're going to have housing starts. Housing starts are set to decline as well, both because of all the factors I just mentioned, but also the fact that you still have a lot of homes that are being delivered right now that were started last year. You have you look at the latest housing market data, and sales may actually have slowed again in February. And the reason for that is you have both a decline in supply, new listings pulling back, sellers saying, hold on a second, I don't know where things are headed. And at the same time, you have demand, people on the demand side, I mentioned consumption easing, saying, hold on a second, my stock market wealth is falling. I'm nervous about the next policy decision from this administration. Uncertainty is soaring. Policy uncertainty is soaring. And so you have both a kind of everybody on hold right now, just waiting.
Yeah, in that equation, there's that you've described. There's a lot going on, and in reality, when there's a lot going on, not a lot happens. Right? Yeah. That causes that. That's where the paralysis by analysis, I think, sets in. Yeah. Not good for the market necessarily.
No, right now, it's like everybody's on pause and waiting to see what's going to happen next. And unfortunately, the longer we wait and see what happens next, the slower growth, the slower economic growth, and the higher the risk that a shock takes us into negative growth territory.
Right.
Right. Which is the part that, right. And so it almost becomes a self-fulfilling prophecy, right? We don't want to, we think things are slowing down. We pause and wait because we're afraid. And then that is what brings on the recession. Yeah. So that's the problem. I don't see a recession in the cards this year, but absent another shock. But I would say we have to be very careful here, because consumers and businesses are just kind of pulling back and waiting to see what happens next.